I'm doing fantastic. So good to see your smiling face.
Absolutely. I'm
Yeah,
excited about this session we're getting ready to do.
I am too. And I think what's first is most important is just a little bit about who we are and really what we wanted to discuss today. So we are both extremely passionate about working with financial advisors and planners, educating them, helping our teams provide better service levels. And it's such a unique environment. Now, myself, a left coaster, you a right coaster, but we also have different roles. So I work a lot on strategic planning in regards to our Mutual of Omaha reverse mortgage products and finding those strategic uses from a larger aspect.
What keeps me excited about where we are right now is that these loan originators who are reaching out to planners across this area is that the things that we're talking about as the market has changed and as the demographics have changed, uh, this whole idea of home equity conversion is an idea whose time has come. And what is so exciting is that the financial planning community is really opening their minds to the idea of this as a prudent and responsible liquidity account. It's another
Yeah.
bucket of
A tool.
liquidity, another asset class that they can tap into. So, housing wealth strategies for retirement, right? And when we're talking about housing wealth, we're talking about the wealth in the walls that are sitting illiquid in the form of home equity. And what's happening is that baby boomers have stored a tremendous amount of home equity, and they're dealing with forces in their retirement that no other generation has ever faced. And we're simply making the case that financial advisors will have to access all of their clients' assets, and this is just one more asset bucket that they can have access to. What we'd like to do is just get into some of the drivers that are driving the massive paradigm shift that's taken place in the marketplace today, in our culture, in our economy, and in our country. And it has to do with Peak 65. And to understand the Peak 65 story, you've got to go back to post World War II, 1946, when 16 million men and women were coming back from World War II. And what they wanted to do is they wanted to come home and start their life. And these
Yeah.
were young people who had seen and been through a tragic and historic time in history, and they wanted to get back to some normalcy. And they came home, they bought homes, and they started families, and they made a whole bunch of babies between 1946 and 1964. And to really look at the peak 65, you have to go back to 1959. That was the peak birth year. In
Hmm.
1959, there was a baby born every 9 seconds, Jeffrey, in this country. That's 4.3 million babies born that year.
Yeah.
Well, in 2024, last year, that was 65 years ago. And that 65 years has been the traditional start to retirement in this country. And so we look at Peak 65 as a massive flow of people who are entering life after work. And we basically, you have this age wave that's cresting 2024, 2025, 26, and then it's going to start to kind of ramp down to 2030. By the time we get to 2030, every single baby boomer will have turned age 65.
Hmm.
And the financial advising community across this country is experiencing that. They are experiencing this demographic, historic cresting in their practices.
Yeah.
When many of their clients that they've been working with for 15 and 20 years are now coming to them saying, hey, we're ready to retire. And of course, that's a big change. And so by the time we get to 2034, a very historic moment takes place where we actually have a demographic age ratio flip,
Yeah,
where there will be,
these are the statistics that just are shocking to me.
yes, yes, in 2034, for the first time in history and forevermore going forward, there will be more people age 65 and older than age 18 and under.
Yeah,
Now, that fact right there, Jeffrey, changes everything. It changes
right.
our economic outlook. It changes how services are going to be delivered, and it changes our social economic system. It changes our culture and where the marketplace is shifting to. And so it's massive. And along with the massive challenges will come lots of opportunity as well. Now, if you think about that, if you think just about the idea that there's more people going to be over age 65 than under age 18, what kinds of challenges do you think financial advisors are going to be facing as we go along in the years to come?
Well, I mean, how do you solve for an extended retirement period that's longer than historically what we have looked at with a finite amount of assets? I think that's, to me, at least what's probably the most glaring challenge. I know that it's much bigger than that, but that's the first thing that comes to my mind.
Yes, and as you and I know, and as every advisor that's on this presentation knows, that as a generation, baby boomers have not saved enough. They're undersaved and they're underprepared for life after work. And also one of the big challenges is the psychology of the big shift from the accumulation stage to the decumulation stage, and
Yeah,
and and baby boomers have concerns, and I think that everybody can agree. And if you ask anybody, what's the number one concern in retirement, and that's running out of money.
right, right.
Well, that's a symptom. That's a symptom, and it's a symptom of not saving enough, not budgeting correctly, not having a long enough time in the market, and not planning ahead enough. But underneath that is not so much the fact that baby boomers are going to run out of money, is that they're going to lose their independence. The independence of a baby boomer is paramount. It's part of their core values. Is the fact that they love their freedom and their independence, and they certainly don't want to be a burden on their families. And I'm sure that the financial advisors on this call are experiencing some of those questions and some of those conversations.
But I think when we look at some of the confluences, there is, living longer sounds great on paper, but then we get into health concerns, the rising cost of care, all these advancements that I'm sure you're going to be talking about. Um,
Yes,
they,
and these demographics, to just let it settle in just a little bit, we want to make the point that we've never been here before. We've
right,
never
right,
experienced the demographics. If you go back to 1900 in our country, there was only a small handful of people who lived to age 65.
right.
When when the Social Security system was set up in the early 30s, it was set up, the full retirement was 65, and life expectancy at that time was 62. So it was not meant to be a longevity. It was meant to be a supplement for those people who outlived the demographics, right?
Hmm.
The models at that time. And in 2022, we had 58 million, and we're over 60 million now, and heading very quickly. Age 85, as a percentage of the population, the fastest growing cohort
Yeah.
is age 85 and above. 122,000 people were age 85 in 1900. We're right at 7 million now. And by the time we get to 2040, Jeffrey, there will be more than 80 million people in this country over age 65. And by the time we get to 2050, there will be right at 20 million people age 85, age 80 and above.
Yeah.
And so we're not only are we getting older faster because of this cresting of the age wave, but the biggest disruption as we go forward, that's going to it's going to surpass everything we've already talked about, and that is longevity. And you
Right.
mentioned that, right?
Yeah.
And right now, the high sciences are driving exponential growth in life expectancy. The high sciences of machine learning and bionics and artificial intelligence and neo nano technologies are all driving life expectancy. And what these scientists are telling us is that if you arrive somewhere in the mid 2030s in reasonably good health, you have a very high likelihood of living to 100 and beyond. Baby boomers will normalize age 100 in this country. The ones that are taking care of themselves, and you see them everywhere. You
Yeah.
know, it's easy to see the ones that are having health issues. However, there's a huge cohort of baby boomers who are out running and they're out taking care of their health and they're vibrant and they're living lives to the fullest right now. And those baby boomers are going to crash through age 100. And that may seem crazy. However, the financial advisors who are taking this in need to understand that that's a big deal. Your clients start taking a look at their health when you're meeting with them and start to imagine that and perhaps they're going to live beyond the models that you've been talking to them about and perhaps stretch out those models to 100 and beyond.
Isn't
What?
there a statistic about the number of 65, those age 65? Um, like two-thirds of
Yes.
all. What's
Yes.
what's
Right now, we're in an evolutionary moment in human history, Jeffrey, and that is that two-thirds of every human being who has ever lived to age 65
that's it.
is alive today.
Yeah.
All right. And
That to
so,
me is it's hard to even fathom.
yeah, yeah. And so that right there says we've never been here before. The challenges and the obstacles that we're going to be facing, it's hard to even imagine and project. It's very difficult to see the future.
Yeah.
And that makes it even more important to take in and understand some of the concepts that we're going to be talking about on this presentation around the asset class that is housing wealth.
So
And
you
so,
so
go
well
ahead.
you've done a great job one at setting up like what's happening, what we're facing. But I think you've done an even better job of summarizing really kind of what are those obstacles? What are they?
Yes. Yes. And what we like to talk about are the three legs of a stool. Okay. And these three legs are going to be necessary for succeeding financially in retirement through all the phases of retirement. And there are three or four major phases throughout one's retirement. And that is that you must have sufficient and sustainable income for living.
Mm-hmm. Mm-hmm.
You must have a strategy in place for care for aging. And you must secure housing forever. You must, and that's a baseline for me. My whole entire 45-year career has been around housing. And one of the things that when I was considering making my shift over into the home equity conversion space, the thing that really tipped the scales for me was the fact that this program, this home equity conversion mortgage program that we're going to be talking about, secures the home. And that's fundamental for me. And what I would say to everybody who's thinking about these three obstacles or challenges are that if you only secure two of them, it will undermine the third. It
Mm-hmm.
would be so many financial advisors that when I begin talking to them, I find out they're not really focusing on all three, and oftentimes they're going to end up with a two-legged stool. And so we want to
Unstable.
make sure that all three of these are being addressed. And so my big question is, can the house pay for the home? And what we know for sure is that the number one expense through all the phases of retirement is housing. It's far and away the number one expense in that family's budget is housing. And so we have all this wealth sitting in home equity that's illiquid.
Hmm.
And the I look at it so clearly. I see it so clearly. And so much of our work is just getting people to open up their minds to the fact that these boomers have developed more than any other generation in the history of this country, more home equity. There's right at 14, heading to $15 trillion worth of available home equity sitting illiquid in the homes of boomers and beyond.
Yeah.
And so, can the house pay for the home for the expense for living in place through all the years of retirement? And the answer emphatically is yes, it can. And that's the appeal that we're making to financial advisors, is that for many financial advisors, securing home or even having a discussion about home is a little bit of a blind spot. And what we want to do is illuminate that there's a solution here for those people who want to age in place. And so, can the house pay for the home? Absolutely. Absolutely. And the other thing that we really want to put on the table here is that the boomer generation is going to do it differently. They're not going to be sitting on the porch, rocking, waiting for their days to end. They're going to be fully engaged. They're looking for social interaction. They're looking for community. They're looking for purpose. And one of the things that uh, one of the great studies, and I would highly recommend that anybody listening to this go to agewave.com.
Yeah.
And Ken Deichwald has done a recent report on baby boomers and how they think. And it's a phenomenal report that's an easy read, it's a quick read, and you owe it to yourself. Agewave.com, get Ken Deichwald's report. And what they have found is that 71% of baby boomers look at themselves as youthful and useful. They really want to live their legacy, and they value extending their legacy with the warm hand rather than the cold hand. 67% said the number one concern about leaving a legacy is leaving a legacy of experiences, life experiences, translating and communicating and sharing their core values and their wisdom with their family and their friends and their community. And so it's a much more youthful retirement. And what we would say to you with these advances, the regenerative health sciences right now are working focused on the idea of closing the gap between lifespan and health span.
Hmm.
There's chronic diseases that creep in the 60s and the 70s, and it's debilitating through the last decade or two of life. And what we're wanting to do is stay healthier longer and be more vibrant longer. And that's where a lot of the health sciences and the research is going. And so that really plays into this next thing that's big. I'm urging the financial advisor to think about this, because it's what their clients are thinking about, whether you're having the conversation with them or not. Right now, there is about 55, 56 million homeowners that are age 62 and older in this country. And all the reports that we're seeing post COVID is that 89 to 93% of them, depending on the report you read,
Hmm.
want to age in place. That's massive. That is a movement to stay in the home that they love for as long as possible. Well, how are you going to pay for that? How are you
Hmm.
going to modify the home? If you're going to live another 30 years in retirement and you got your roof replaced 10 years ago, they're going to have at least one more roof, right? So
Yeah, but
just
you also
think,
said modify too. I think that's really important when you talk about aging in place, right? Whether there's stairs to navigate, whether there's handrails in the bathrooms and the showers. I mean, that's what you're referring to about modifying the home, correct?
yeah, yes, universal design is a real thing out there, and there are specialists who do modifications for not just people who want to age in place, but for disabilities and various different mobility issues. And so, yes, that is a whole business in and of itself. Also, also aging in place doesn't mean that they're not going to have another home.
Right.
Okay, aging in place means that they want to stay in the home and in the community that they love rather than going to a retirement community or a facility. And
Hmm.
so a lot of baby boomers will need to buy their final forever home and get on one level and make sure that it's appropriate for aging. However, they want to stay there. And one of the most important values, core values, that boomers cherish is their friends and their neighbors and their community and being engaged, being involved, feeling as though their life still has purpose and that they're not going through isolation. So, I'm just urging uh, every financial advisor to put home and where they want to age on the table for conversation and go in depth on it because there's a way that the house can pay for the home. And when they understand the line of credit and what it can do, it can keep them safely in their home, which is where they really want to be. And so riding this age wave not only has massive challenges, it has huge opportunities for the advisor as they're shifting from the accumulation stage to the distribution stage.
Hmm.
And, what I'm seeing right now, talking to the financial advisors that I speak to, is that we're very quickly moving from a savings crisis to an income crisis. And what I would say is that a person's success in retirement will be directly proportional to how much net spendable cash flow they control.
Right.
And so the advisor's looking for sources of income and they don't need to look any further than just to look at the home as another asset bucket that can be safely and prudently converted. And we have this massive transfer. This is another thing that I run into a lot. And we know statistically that we got $80 trillion between the World War II and the silent generation and the baby boom generation, about $80 trillion of wealth that's going to be transferred down through the generations. And what I would suggest is that the vast majority of that 80 trillion will be going through women, through
Hmm.
the wives, through the widows, because we all know that in most cases, you either have women living by themselves because they're a divorcee or they have lost their husband. And I cannot tell you how many times I've heard when I'm talking to a widow who has lost her husband, yeah, my husband used to take care of our finances. I'm looking for a financial advisor. His financial advisor and I really didn't get along. And so
Yeah.
I just encourage the financial advisors to make sure that all the voices of all their clients are being heard, and even down to the next generation, that aging is a family affair. And what we know is that when both husband and wife do pass away, 67% of the children who take over the inheritance and the estate, they move the money away from the advisor that
Right.
help build the estate. And so aging is a family affair, and we want to get all the voices around the table so that the financial advisor is aware of the dynamics in the family and what the wishes are to age in place. That's a really, really, really big deal. And then I'll end with this piece, Jeffrey, and kind of hand it over to you.
Yeah.
And there's a rule, there's a basic rule, a fundamental rule. It's just rule number one, and that is that you shore up your lines of credit when you don't need them, so they are in place when you eventually will. And it's never been more true than it is right now, especially with the advantages of getting into the home equity conversion mortgage earlier rather than later. And I know that you and I will get into that discussion as we go forward.
Yeah.
But why don't we share this slide here, Jeffrey, and just talk a little bit about uh, this most ignored asset class. When you see that the housing wealth, the most ignored asset class, what does that conjure in your mind?
Well, as far as being the ignored asset, I think it has historically been ignored because it really didn't know what to do with it, right? It's a consumption good, right? In other words, it's an asset class that you hold, but you need it, right? You utilize it, right? You live in it. And it's got high transaction costs associated with, if you sell. Um, it's got a deep emotional attachment to it. So I think from a planning perspective, it's kind of been ignored.
Yes, and many financial advisors that I've talked to kind of view it as a sunk cost and
Hmm.
that they're not going to have access to it. And even the ones that I begin to work with and they fully embrace the idea of equity conversion, there's some hesitation to bring it up to their clients because of that emotional attachment they have to the house. You mean you want to put a mortgage on my home? Wait a minute,
Yeah,
what?
yeah, yeah,
Right? We work so hard, and so we have to go to the next step and open the minds of their clients to the real value of the sooner that you tap into home equity and a coordinated strategy, then your overall outcomes are going to be enhanced in the long run. And as we go through this and we talk about this, it's going to become very clear to the financial advisor that that's true. Because one of the big misconceptions is that a conversion mortgage should be a loan of last resort. You spend
yeah.
down all your other assets and you get it later in life. And all the research tells us that that's exactly the wrong way to go about it. And I know that we'll be making that point as we go along.
Well, I like the fact that you stressed a coordinated strategy, right? And I think that's kind of what we're going to get into, is not deplete all the assets and now let's leverage the home as the last resort. Let's coordinate this earlier on in the planning to create overall greater successful outcomes.
Right. And probably the second thing that I love the most about this loan program, this mortgage program, the first one is that it secures the home. And we really want to make that point as we go through this, that not only is the couple secure, but the surviving spouse is going to be secure in that home as long as they live in that home and own it as their primary residence, maintain it as their primary residence, and continue to pay their taxes and insurance. They can live in that home for as long as they want to. They can sell it whenever they need to. The key is that they're secure in that home for as long as they do those four things. They can stay in that home as long as they want to. And they will never have the burden of making a mortgage payment. There's never going to be a required mortgage payment as long as they live in and maintain the home and pay the taxes and insurance. That's all the loan requires as they go forward. So there's a lot of advantages to tapping into it early. And we start looking at the growth of the line of credit, it's going to open up your eyes as you really get deeper into it. So stay with us through this next phase because we want to give you some details about how the loan actually works. So
Yeah.
let's go to this one, Jeffrey, and why don't you take it from here and just kind of take us through these slides and
Yeah, so I think from most advisors that leverage the product, approach it from this perspective, which is, someone that is carrying a mortgage into retirement. They have assets under management, and now those assets are depleting, like you said, like a last resort strategy. Uh, and so that mortgage is now putting pressure on those cash flows. And maybe we see a time period where they may run out of assets. Um, and so we're brought in to look at how we can alleviate that mortgage payment. And then really it's a cash flow tool when we look at it that way. And I think it's a great place for us to start. And I think the best way is let's make a comparison to our product, the HECM, the home equity conversion mortgage or reverse mortgage, commonly known, with a regular mortgage. So let's model that first. And let's use a client like an affluent couple, a 62-year-old couple, Tom and Sarah, a $750,000 home. They're really indicative of the young baby boomers that you're talking about. So they are both still actively working. There's no immediate need today. Their plan is actually to work up until age 70 or either defer taking Social Security till age 70 so that they can get the maximum step up. But they're smart. So, rates were low 2 or 3 years ago, extremely low, and they understand leverage. So they took out a $200,000 15-year fixed at 3%. They use that to help their grandkids in college, help their adult children buy a new home. That comes with a monthly payment obligation of 1381. And let's also assume that the home is appreciating at 4%. So there's our inputs there. Here on the left, we've got our $750,000 home value. We've got a 3% interest rate. They took out 200,000. We see the home appreciating at 4%. Of course, their age at 62, and then with that monthly payment of 1381. So if we model this on the bar chart in blue, you can see that home at 750, and it appreciates at 4%, 5, 10, 15 years. You see that going up. And then the initial at 200,000 was the consummated 15-year fixed loan. And they make those $1,381 payments, and you can see them paying that down through 5, 10, 15 years and paying it off. But what's interesting is we're looking at it, as aforementioned, as a cash flow tool. So if they carried that loan to term, they would make total mortgage payments of $248,608, and we'll come back to that.
Yeah, and
So,
it should also be noted that that's $250,000 of after-tax cash flow
yes.
that is committed. Because if they don't make those payments, they lose their home, right? And so that's baked in to their future assets in retirement.
Yeah, and and saying that it's after tax, right? So it's either proceeds from them working, so salary, wages, or it's they are in retirement and it's coming from qualified accounts that most likely they are paying taxes on. So let's
What's
take
this
a look.
slide telling us here, Jeffrey?
So this is why I think comparing it to a regular mortgage and kind of seeing how it works over time makes the easiest understanding, but also introduces some of the really great features that we're going to dig into. So we use the same $750,000 value. We're using kind of a higher interest rate than current, but we're just reflective of the high interest rate environment we've been in, and it's truly kind of for illustrative purposes. Um, the amount that is available to them is based upon the home value, the interest rate environment, and their age. So
So you're
based upon,
talking about the line of credit now. So you're
well, I'm
doing a
talking about
refinance.
if they actually refinance that scenario,
Yep.
300,000 is what would be available to them, and we call that the principal limit. And
Okay.
it is based upon those three factors, right? Home value, interest rate environment, and their age. Our closing costs are 24,000, and I think it's so important to note that three-quarters of that cost is actually an upfront mortgage insurance premium that's paid directly to FHA and HUD. And the reason why I want to stress that is it's actually what creates these incredible features and protections and safeguards that we're going to talk about. So then they pay off the 200,000 15-year fixed. We're using the same appreciation at 4%. So as we turn towards the bar chart, You can again see the home value appreciating at 4%. At consummation of loan, in gold is their starting loan amount. So they paid off the 200,000 15-year fixed and the closing cost of 24,000. But what is unique is that total principal limit of 300,000, they make the remaining amount available to them in a line of credit starting at 76,000. Now, that loan is, remember, it's a cash flow tool. So they have complete flexibility, right? As long of whether they choose to make payments or not. In this particular case, we're going to show that they're not making payments. So any accrued interest gets rolled back into the principal, and you can see in gold that that loan balance is increasing. But I want to really zero in on that initial line of credit of 76,000 because by year 5, as long as they defer that and they haven't touched it, remember this is a young active couple still working, you can see that line of credit begin to grow. By the time we get into year 15, that line of credit has grown to well over $224,000. Now we're talking about a standby bucket. So if you go back to what you had said in terms of making those 15-year mortgage payments with taxable funds, they've now saved cash flow of 248,000. So imagine what that would do back into their plan. But on top of that, they now have that 224,000 standby line of credit.
So that's a $500,000 of liquidity swing.
Yes,
So this is a liquidity play.
it 100%.
Okay. That's fantastic. That's really fantastic. And then so what would happen if they, you're going to get into a little bit later if they
I
do
am. And
choose to
I
make
just I
payments,
want to
right?
point out that one, we've now introduced one of the real incredible features, which is if that line of credit is deferred, that it grows over time and it grows at the exact same interest rate as any borrowed funds.
Okay, fantastic. Great.
So we just stated there that it compounds monthly guaranteed. And again, you've paid this upfront mortgage insurance premium. So it grows irregardless of the home value. So even if the home value fluctuates, it's not tied to that. And what's also great about the upfront mortgage insurance premium is that it cannot be canceled, frozen, or reduced as long as their loan terms are satisfied, which you previously mentioned, making sure you've paid your property taxes and your insurance, any HOA dues, things of that sort. So again, that upfront MIP that you pay not only creates this guaranteed monthly compounding growth, but if you go back to 2008 into the Great Recession, many seniors had HELOCs that was their standby emergency bucket. And the banks involuntarily close or froze those lines of credit. This
I
is
had two,
insured.
I had two shut down in 2009, Jeffrey.
Yeah, I
And,
did
and
myself.
so, yeah, I have been the beneficiary of that risk. And so when you can compare a HELOC and the risks associated in retirement with a HELOC versus the guarantees and the assurances of a HECM line of credit, to understand both, you would never, if they can qualify for both, you would never recommend a HELOC over a HECM line of credit simply because it mitigates some of the risks of a traditional HELOC. And also, I want to emphasize something you said to the advisors on this call, and that is that housing can be volatile. Now we know it is as an appreciating asset over time, but your baby boom clients, they remember 2008 and 2009.
Yeah,
And so we do know that housing prices can go down. They rarely do, but they can go down. And what Jeffrey was saying is that as soon as the line of credit is set up, it is no longer tied to what the house value does, the home
right.
value does.
Yep.
So your line of credit is guaranteed to go up and grow, even if your housing prices do go down. So now you've got a nice hedge there. The worst place that you can be when housing prices go down is in cash because you're taking the full brunt of the loss. this line of credit and this liquidity is going to continue to grow, whether the housing prices continue to go up or not. So just wanted
Yeah,
to make sure we got that out there.
agreed. And we can stress test that here, I think, in the next slide. So let's go back to that same couple, right? 62-year-old couple, $750,000 home, very active, no immediate need today. But this is where it starts to get interesting. So remember, they said they were still going to work and defer Social Security till age 70. So what if they made the same monthly mortgage payment that on the 15-year fixed of 1381 for 8 years? And then let's also assume that real estate doesn't appreciate during this time period. So we can kind of stress test this. So
Okay.
same, there's our inputs. All I'm going to do is just zero in on the home appreciation value is set to zero, and they're going to make payments for 8 years. So you can see in blue the home value unrealistically did not appreciate for a total of 15 years. If there's anything stress testing in the model, that would be a home not appreciating in 15 years. But let's assume worst case scenario. Again, they start out at consummation in gold, right? They paid off the 15-year fixed plus the closing costs. They start with a loan balance of 224. They start with that same line of credit of 76,000, but then they begin to make those 1381 payments for 8 years. Now in year 5, you can see that they've slowed the rate at which that balance has grown to 221, but look at that line of credit. It has ballooned to over 208,000 just in the first 5 years. By the time they get to year 10, it's over 360,000. By the time they get to year 15, not only do the payments that they made towards that line of credit or towards their balance grow the line of credit dollar for dollar, but then you also have that monthly compounding. So by year 15, we're talking about that standby emergency bucket of $521,000. So they paid on the loan for 8 years. They didn't have to carry it to full term, so they did also have cash flow savings of 116,000. But again, there's that standby line of credit at age 77 of $521,000, and it's insured by FHA and the Department of Housing and Urban Development.
Yeah, and I think it's probably a good idea to bring up the concept of non-recourse.
Yeah, so we could stress test this and say that, in year 15, let's say that real estate actually declined. Maybe it was a 2008 event. And if we modeled it, the same would be true. That 521,000 would still be there, even if the home value was at 400,000. And at that time, that crossover point, nothing happens. This line of credit is still in place. It's still insured. There's nothing that happens that now is removing them from the home or calling the loan due and payable. And that is what we refer to as non-recourse.
Well, also, the advisor needs to be mindful that if their client, and by the way, about 45% of 65-year-olds are still making a mortgage payment,
Yeah.
and 28% of 82-year-olds are still making a mortgage payment. So it's not unusual for people in retirement to continue to make mortgage payments. And if you're in a upside down mode in a traditional loan, they're going to the other assets to collect.
Hmm.
Non-recourse means that the lender, we service our loans, the lender who's lending the money can only go to the house for recovery. Now we're getting into the value of the insurance, and that is that the heirs and the other assets are protected. So if we're starting to get volatility in the market and housing prices are dropping, you can protect the other assets, and you could draw money out of this line of credit, and the lender cannot go to the other assets. And so if we take a loss when they pass, if they are upside down in the home when the last remaining borrower leaves that home, we go to the FHA insurance fund to cover our losses. We do not go to the other assets.
Yeah, and I also think it's important. So we started out mentioning last resort strategy, and I do want to say a couple things about that. You know, I look at the industry in terms of baby boomers as there are needs based and want based. And needs based to me is a couple that is carrying a large mortgage into retirement, they don't have a lot of other assets, right? And now that cash flow of that mortgage is crippling them. We can help them with a reverse mortgage. Typically, they don't really have a lot of other options. What I'm talking about is want-based, and want-based is more a financial planner client, right? And there's a reason why we chose Tom and Sarah, a young active couple. They have assets under management. They only took a mortgage because it was cheap money to leverage. But if you look at this scenario and look at the affluent families that don't have a mortgage at all, you would start with a 300 or a $270,000 line of credit at consummation. So by the time you get to year 5 or year 10, you're talking about a massive line of credit versus not having they don't have a balance to begin with. So I think
But
it's important to note. Yeah.
no, I'm sorry, I didn't mean to step on your words there.
No, I think it's important to note that the most successful use is want-based because you're leveraging it truly as a standby bucket. And that's really what we're going to go in and start to model next, now that we've really talked about that credit line growth feature and those protections.
Yeah, and one more thing to add on what you're saying there, Jeffrey, which was really powerful, is that uh, rarely does a financial advisor have a client where everything's perfect and there's no gaps and everything's planned out. Those might be the top 15 or 20% of their clientele that have no worries and so on.
Well, there's a lot of
Most,
stressors, right? So peak
yeah,
65, as you mentioned, to solve for those three things,
yeah,
there are a lot of stressors, and we're actually going to go into modeling some of those big stressors.
yeah. And what I would simply say is that the advisor that's looking at their client base, most clients that they're dealing with have some weakness in their retirement income plan. There's some gap, there's some oversight, there's some shortage somewhere in it. And probably the second thing that I love about this tool is that it's customizable. It's extremely versatile. I've never done the same loan twice. And so that coordinated strategy that we were talking about earlier is that the financial advisor is leading the conversation and working with us in a coordinated way to make sure we're customizing the application of this tool in a way that is going to solve the problem or have the desired outcome.
Yeah, so here's where to me, it gets very interesting. So we've talked about just the basic use in that previous example, but I think another way to really hit home about how that line of credit, if deferred, can work is to kind of compare it to a product that most advisors understand. So let's take a look at what that line of credit as a buffer asset could do in comparison to a deferred annuity. Now, please understand, I'm not trying to be a proponent of annuities or an opponent of annuities. They are very complex, insurance contracts. I'm just looking at it from a very, broad brushstroke. But what's interesting is if you look at the terminology within annuities, they relate very much to our growing line of credit. So we have accumulation value, we have benefit base, we have a floor, we have a cap. And in terms of an income rider, those we refer to on our side as term payments or 10-year payments, which I'll explain as we model. So if you put them side by side and looked at a deferred income annuity, right, the accumulation value, as long as they have not utilized the income feature, then it's going to accumulate in value over time, and thereby it's also going to increase any estimated benefit base. And as you'll see as we model this, it's the same with this reverse mortgage line of credit. So here, what we're looking at is we've got a home in the top line in green that's appreciating at 3%. At age 70, they consummate this reverse mortgage loan, and that line of credit will grow, but it's going to grow based upon different parameters. And what we like to use, or FHA requires, is an expected growth rate. And that expected growth rate is based upon the 10-year treasury and our lender's margin. So if we look at base growth, it would be an assumption that the 10-year treasury was at zero. Pretty unrealistic, but it could
Yeah.
happen. Let's say if it was at zero and just the lender's margin, then the base growth would be right there at the blue. Expected growth at 7.685, and then caps, we have caps based upon whatever interest rate environment. So in theory, that line of credit is going to grow most likely along the gold line, but could be anywhere in the light shaded blue. Now, um, go back one slide. Again, we talked about the home value unrealistically being at 0% appreciation. So you could see that principal limit continuing to grow. Remember, it's guaranteed to grow and compound monthly. I want to zero in on this slide because this goes back to what you had mentioned about non-recourse and the
Yeah.
upfront mortgage insurance. So if you
Yeah.
look to the top right portion, if we remained in a very high interest rate environment at those caps, in theory, that line of credit could grow up and beyond the actual home value. Again, keep in mind, not only is it non-recourse, but that line of credit would still be available to use as a bucket during those times of stress. Now, what's interesting is that at consummation, if we know the expected rate, which we use at the time that we close that loan, we can calculate out the future withdrawal rates, which what we refer to as tenure payments. In other words, at what rate can they begin to draw down guaranteed from that line of credit for as long as they are living or as long as they living in that home. So in this particular case, at age 70, they consummate the loan, they defer taking the payments from that line of credit, it grows. And at age 80, we know that they could have tenure payments guaranteed fixed income at a rate of 10.11% of whatever that principal limit would be.
So you're basically taking the latent illiquid home equity and annuitizing it in a monthly payment.
Correct. And so now you can kind of see the terminology is very, very similar to a product that advisors understand. This is just another way to look at it, right? So in light blue, they defer accessing the line of credit, it grows. At age 84, they begin to take 10-year payments in green, fixed income payments, and they begin to draw down that line of credit. As you can see in this particular case, they were definitely healthy peak 65 boomers.
Yeah.
So they lived beyond even the value of what that line of credit was. But those payments are still guaranteed to be made to them. So we talked about, our health spans matching our lifespans. So I think it's important to really dig into some of the stressors that advisors have to deal with their planning. And the biggest one is the loss of income for a passing of a spouse. But second, a major stressor is silver divorce. How do you solve for the division of all of those assets? And equally, how do you solve for two primary residences? It can become very tricky from an advisor's perspective. And a reverse mortgage, as that tool with that standby bucket, can make that solution much easier.
Oftentimes one of the spouses wants to stay in the home, right?
Yep,
And so they can use the equity, liquidate that equity to pay the moving spouse, the spouse that's going to move out, and then they can go and buy a house on their own
yep,
with the liquidity as a down payment for the next home.
correct.
Yeah, that's fantastic. Another great use of it. And then, of course, you got tremendous financial shocks. I just gotta take a pause here and just send out massive admiration to those advisors who do retirement income planning. It's got to be the hardest job in the financial services, the financial planning world is to do real life retirement income planning because the two of the most important pieces of information that's going to affect your outcome, you don't know. You
Right.
don't know how long they're going to live, and you don't know what unexpected expenses are coming around the corner. Now, you know they're coming. You
Yeah.
just don't know what they are and how fast and how many. And so it's an almost impossible feat. And to just double down on making this point, you shore up your lines of credit when you don't need them. And in this case, with the HECM, you want to get into it early because of the time value of money, it's growing. So
Correct.
the earlier you get in, the better, so that down the road, you have liquidity, another additional liquidity bucket, so that you have greater liquidity use and control that most retirees don't have when they leave their equity illiquid sitting in the home dormant. And so you have liquidity, you have another bucket of liquidity and cash flow. You have the use of that asset class, and you have greater control over how to make decisions to handle those unexpected expenses. Should we pull it from the portfolio? Should we pull it from short term savings? Or should we pull it from the equity in the home? Right. And
Yep.
so just greater, better tools, more tools for the advisor and their clients to deal with the unexpected. All right.
So we talked about stressors and cannonballs and all the pitfalls of Peak 65. So I really think one of the biggest stressors is a long-term care event. Um, so how can we solve for a long-term care event by deferring or delaying those initial credit line growth, right? So remember that the available line of credit grows at the same rate as the note, and that we can convert that line of credit into fixed monthly distributions
At any time.
at any time. And the compounding growth allows for those fixed payments to increase until initiated. These proceeds are a loan, and accessing your home equity is not a taxable event. Again, I would say please consult your tax advisor. And then we also talked about that upfront FHA insurance that protects the borrowers and their heirs if the borrowed loan amount ever exceeds the value of the home. Again, non-recourse. So let's
So
model that. Yeah.
a question right there, Jeffrey. So they're allowing the line of credit to grow, and then they have a health event where we're going to need to bring in-home care, and it's going to run eight or $10,000 a month for, I don't know, 3 or 4 years. Once you turn on those payments, can you then turn them off later? Is there
You can,
flexibility?
and we're gonna talk about that. It's that
Great. Let's
flexibility that's a fantastic tool. So let's look at Jack and Jill, 70-year-old couple, $750,000 home. They own it free and clear. No immediate need today. So concern number one, what if one spouse passes and they have a reduction in income? So at consummation, they started with a $234,000 line of credit at age 70. You can see that as we had aforementioned in terms of the rates at which it can grow. So along that gold line, you can see what might be expected for that line of credit to grow based upon different ages.
And it goes on out to age 85 and 90. We're at 1.1 million by the time they get into their 90s.
Yep. And we're going to stress test it here. So let's look at the fixed payment conversion. So we understand the line of credit growth. We also knew that we could calculate what the future withdrawal rates would be. So if we look at the expected rate, the gold line, at different intervals of where we believe it could be, we can also match that with the withdrawal rates to better understand what the future income possibilities are. So here what we did is those three different bar charts. If you look at age 80, the 29.84 per month that would be guaranteed fixed income for as long as they're living is based upon a base rate, which again, that would mean that the 10-year treasury was at zero. More realistic is the expected rate of 44.70 guaranteed fixed income payments. Now, if interest rates remain high, like an environment that we are in today, those payments could be upwards of over 8,000 per month guaranteed to cover the loss of family income from the death of a spouse.
So they let the line of credit grow, and then they want to trigger or turn on the monthly payment.
Yep.
From that moment forward, whatever time that is, that monthly payment's going to be guaranteed for life.
Yep. So we've compared it to an annuity in terms of understanding deferring and letting it grow, and hence the plea to make sure that this is put in place earlier to make that bucket larger. And now we've extrapolated from that potential incomes, monthly incomes. Now take a look at a long-term care event. So we're talking about creating income loss protection and fixed term payments. So this same 70-year-old couple, right? We solved for what if a spouse passes, but let's take a look now for concern number two, which is what if they have a long-term care event? So in this particular example, Jack needs 10,000 per month for 4 years. So an extended long-term care event. We're talking about
Yes.
480,000 of a long-term care event that all could potentially be self-funded with the home equity. So you see at age 70, that line of credit is growing because again, they are deferring accessing. And at age 80, they begin to take those draws, 120,000 per year for 4 years, so fixed payments. And then they stop at age 84. So that line of credit can actually go back and begin growing again. So advance through, and I want to talk about the flexibility that it creates.
Okay, and just as a point though, to anchor this slide right here, Jeffrey, which is
Hmm.
extraordinary.
Hmm.
Imagine the line of credit was never set up. Most financial advisors don't have this tool in place right now.
Correct.
So where's that $480,000 going to come from, Jeffrey, if they don't have the line of credit? It's coming out of the portfolio. So,
Yeah,
not only are we showing them showing the advisor this solution, I know that you as an advisor, you're thinking about preserving the portfolio and what that would mean if you had this tool in place, what else is possible, or the dire consequences of bleeding down the portfolio by $500,000 and now the spouse dies. What's left with the surviving spouse? And we see that every day.
yep,
So
yep.
thank you for pointing this out.
So here's where we talk about the flexibility. So we're talking about being able to turn on the fixed payments that are needed for long-term care for the term in which they choose. And there's no ADL or activities of daily living requirements. In other words, they are not at the mercy of what the insurance company requires for that long-term care contract if they have insurance. Um, it's a cash benefit and no claims process. In other words, it's not about reimbursement. Again, we talked about these being loan proceeds and home equity, that it's tax free. And again, complete flexibility of when they want to turn those payments off.
Okay, so what we're doing is we're comparing deferred annuities to the HECM line of credit and what it can do as a tool. It's almost a converse or an opposite. It's almost reverse. You almost have to think about it in reverse because
Yeah,
an
yeah,
an annuity is taking liquidity and dumping it into an
a
illiquid
contract.
asset until it's needed or if it's needed. With a home equity conversion mortgage, you're taking an illiquid asset and you're turning it into a liquid asset. It's the opposite.
Yeah, and if you pulled money out of a plan to put into an annuity contract to help longevity by having future, fixed payments, the challenge is if they needed them earlier, right? Then there could be surrender charges and other fees associated with converting that contract.
And what's the impact of pulling the money out for either a long-term care contract or an annuity contract? What does that do to the portfolio?
Correct. So let's talk about Jack now with a progressive long-term event that also ends with upon his death. So we start out in year one, 5,000 per month. Maybe it's just needing somebody to come by a couple days a week just to help out. Again, they don't have to meet any ADL requirements. Jack's condition worsens into year two, so there's more care that's needed. As we get into year 3 and 4, now we're talking about around the clock care in home. Um, Year 4, we're talking about palliative care, hospice, which is extremely expensive. So, we're talking about the culmination of a 588,000 long-term care event. That is significant. We call it cataclysmic. But what's unique is that if you look at the drawdown period at age 80, right, it's an aggressive drawdown. But at age 81, now keep in mind, Jack has passed away. So not only has they weathered the storm of a $588,000 long-term care event, but Jill now has a loss of family income. So there's still a remaining line of credit that can be annuitized into tenure payments to create additional family income for Jill. And I think it's important to note, and you and I spoke about this before, Paul. I, we're not comparing this to say this is better than a long-term care policy. But when you look at long-term care insurance, there's a lot of moving parts, right? There is, did they get a policy in their prime, which I think they say that the best time is within your mid 50s. How long have they been paying into the plan? Have the premiums gone up? And I think what's a bigger issue is that when you like, if I look at long-term care plans for me today, my challenge is if I look at a plan that's 300,000 in care, by the time I might need that 10 to 15 or 20 years from now, the cost of that care is going to be well above $300,000. And so what you and I talked about is it's not an or, it's kind of an and. And so you can put this in place, let it defer, and have that bucket. And if you don't ever need to use it, all that home equity goes back to their heirs and their estate. But if you do need to use it to supplement an expensive long-term care event or to save all those premiums and completely self-fund a long-term care event, you have this massive tax-free bucket that has now shielded all of your other assets that are under management.
Yeah, and that's a brilliantly said. Well said there. And I would just add to it is that many financial advisors that I first at first meeting them, or customers, clients, homeowners that I talk to directly, they go, "Oh, we already have that taken care of." And so, they're this is not an or. This is an and. This is in addition to. And when you take the context of peak 65 and the risk of longevity and the additional unexpected expenses that are still coming around the corner, you want to have all the assets liquid and in your control where you can use them in the most effective way to deal with whatever life throws at your clients. And so don't think of it as an either or. Think of it as an additional asset bucket that you can add into what you already have in place.
Correct. So yeah. So now we've solved for, right, loss of family income, and we've also addressed the stressor of a long-term care event. So we tackled two of the biggest stressors or cannonballs that Peak 65 is faced with.
Beautiful.
Now,
And
I think this is great because, the previous ones that I created were in a lab, right? Kind of looking at data. But, you and your team are out there helping real life clients. And I know that it's both a passion for you, but it's also highly emotional. So you selected a real life client that you wanted to share.
yes, and I have sat down at more than 4,000 kitchen tables. And when you sit down at 4,000 kitchen tables, you learn at a visceral level what people care about, what they worry about, what keeps them awake at night, what keeps them divided, what they aspire to, what's important to them in their lives. And their home is where they come from. It's the sanctuary, and people want to stay there. People want to live in their home, and they're planning for it. And they're planning for it missing they have this huge blind spot because they're only thinking in terms of two options. You either pay your house off, right? You get your house paid off, or you carry a mortgage into retirement. They don't realize that there's a third way. And what we're talking about here is presenting to the advisor and their clients that there's a third way right down through the middle of it, in that you can leverage safely and prudently in a coordinated way uh, some of the illiquid equity and convert it to cash. And you can secure the home at the same time
Right, right.
without taking on the burden of a mortgage payment. And that's what we're talking about. So this case here, the Wilshires, was a real interesting case. And they came to me from their financial advisor. So here's the Joe and Connie, wonderful couple. He plays competitive tennis and she runs half marathons.
Not
They're
pickleball.
gonna live
Not
forever.
pickleball, right? You said
Yeah.
tennis. Okay.
Yeah, tennis. He's still playing tennis. He'll
All
probably
right.
end up playing pickleball, but he's going to resist it as long as possible. And Joe and Connie did everything right. They worked hard. They saved. He started out his career as a builder, like myself, and so he built their forever home, beautiful home, and it's paid for. $1.25 million home paid for. And they have four kids. They all live locally. They're really engaged with their family. You can see he's got about $5,100 of really secure income, and she has $4,200. So they're at about $9,300 a month of secure, solid income. And they're a little light on the nest egg, and this
Mm-hmm.
is where the concern started popping up.
Mm-hmm.
And what triggered the concern and the reason they came to me was his mom and dad came to live with them. They finished out the basement. Now mom and dad are living in their basement, and Joe and Connie are the primary caregivers. And his dad doesn't even know who he is right now. And so it's very sad, very emotional. And they're looking at their plan, and Joe and Connie realized they had no long-term care strategy, and it scared them. And it
Yeah.
was the experience that of having mom and dad come home and the burden that they were taking on. And they looked at their four kids and they said, we don't want this to be our fate, and we certainly don't want to be a burden on our children. So they went to their financial advisor and said, can you teach us about long-term care insurance? Then, of course, the financial advisor did just exactly that. And it turns out that the cost of their two policies was going to take about $400,000 of their $550,000 nest egg. And they said, well, that's not a solution,
Mm-hmm.
right? What if we don't need this long-term care? What if we and so the advisor said, you need to go talk to Paul. They walk into my office, we sit down, and I show them that we can set up a line of credit. Now, as I was looking at it, their risks to me were that they had a very small life insurance policy, and they were going to lose almost 50% of their household income when one of them died. So I saw those risks. And of course, the portfolio was going to be really vulnerable if they had a long-term care event, which is what we just talked about. So
Yeah.
here's what we did. We set up, they did not need any cash. They did not want to use any of the money. They just wanted to see what could the line of credit grow to. And so we set up a $376,000 line of credit, and they walked away. They didn't want any cash. And he said, just show me what it's going to be in 15 years and in 20 years. When they were in their mid 80s and going toward their late 80s, they wanted to know what could it be. And at the end of 15 years, assuming a reasonable rate of growth, that interest rates stayed relatively high. We're not talking threes and fours.
Yeah.
We're talking sixes and sevens. If the interest rates stay in that track, their line of credit was likely to grow to approximately $1.2 million in 15 years, and it was going to be $1.5 million in 20 years. And so they just looked at each other and said, "There's our solution right there."
Yeah.
Because they set it up and just let it grow. If they don't need it for a long-term care event, it's just equity that goes to the kids in terms of the estate. And so we also, at the same time, this is also an emergency fund. It could be a buffer account
Right.
against market volatility as well. This line of credit can serve multiple purposes. However, what prompted them to set up their HECM was that the long-term care gap that they had. And so it improved their liquidity. It's certainly a hedge against inflation and payment shocks that they know are coming too. So that was a great case. And the financial advisor who sent them to me has sent me many, many of their clients because there's always something to deal with. And home equity is just a tool in his toolbox. He understands it. He doesn't lead with it. He just lets the situation unfold and goes, this is a perfect application of liquidating and converting some of the equity into cash. So, what about these costs? And how are the costs paid, by the way, Jeffrey?
Yeah, so I think it's important to, as we look at how important this bucket can be, it's not too good to be true, but it is too good to be free. So we did mention those closing costs of 24,000, of which three-fourths of that is made up for the upfront MIP. Those can be financed into the loan. Only out-of-pocket expense would be the cost of an appraisal upfront. But it's important when we're working with our clients to kind of understand their long-term goals. 24,000 left accruing and added over time can grow to be, a significant amount. So we do encourage them, if possible, to pay down those closing costs. And if you remember, when we modeled payments, if you click through here, what it means when you make payments. So they can make these voluntary payments at any given time. There's no prepayment penalty. And again, any payments toward that loan balance, which in this case would just be the closing cost, would increase that line of credit availability dollar for dollar. So it's important to know that not only those closing costs, they are what create the line of credit growth and the protections, but it's also important to understand why paying them off would be beneficial to an affluent standby line of credit bucket strategy.
The closer that you look at it, the better it will appear. There's no gotchas. This is an FHA product that is regulated by HUD. It's designed for retirement and it's designed to meet the challenges and the opportunities that of the times that we're living in. What I would offer you is that if you have a case that you would like to look at, the loan officer that you're talking to at Mutual of Omaha or myself or Jeffrey, you can reach out to us and we'll run a case for you and we'll model it for you so that before you talk to your client about converting some of their equity into a line of credit, let us show you what it can look like. And the more that you talk about it, the more that you grasp the language of it, the more confident that you will be in putting this on the table as a discussion point. For the clients, whether you're having the conversation with them or not, they want to stay in their home. They love their home. And when an advisor puts that conversation on the table and has a plan for them to stay there safely and securely and to enhance the outcomes for staying in their home, they're going to care very deeply about the advisor that puts that on the table with them and has that discussion. So I'd encourage you to bring the issue of housing and home as a center point, as a conversation point for planning the future. And by incorporating home equity into your conversation and into the asset classes that you're managing will enhance everything else that you're doing for them.
Thank you for taking the time. I'm hoping that this was enlightening. And please reach out to your local Mutual of Omaha Mortgage professional, and we can model something in numbers that may be specific to your market.
As we wrap this up, I have a final question for you, and that is, who have you been thinking of in your client base that may benefit from a home equity conversion mortgage? Contact me. Reach out to me, give me a call, email me, let me know that you have a case that you would like me to run through my illustrator, and then you and I can review it together. I look forward to hearing from you soon, and in the meantime, I wish you the very best.